Good morning, everyone. Hope you are all keeping well. We continue with financial instruments. Okay. Good morning, Swaminathan. I have a question, but it relates to business combination. And I suppose you are asking the question on reverse acquisition. Uh, right now, I cannot be discussing that because this is on financial instruments. Maybe later on we can see. Otherwise, I suppose I had shared the detailed working of this earlier, so you can have a look. Even this must be already uploaded, so you can have a look there as well. Okay, so just go through it. Okay, I'll not be able to discuss now because the topic is something else. Okay, maybe you can discuss it when business combination is a part of the session. Okay. All right. So coming back, good morning, Panu. Good morning. Good morning, others. Okay. So in the last class, we had a marathon session where we discussed about off-market transactions in detail. We saw the transactions, we saw the questions related to off-market transactions. Now there is only one thing which is left, that is if a prepayment option is exercised. Okay. But I will not be doing that right now. I will be deferring it. Okay. So we'll continue with the remaining topics. Okay, today I'll be starting off with convertibles. First, we will complete the financial asset reclassification that we had done in the last class. Okay, good morning, Vikalp. Good morning. So in the last class, we discussed that is reclassification possible? Well, for equity instruments, not possible because there is only one category of accounting. Fair value at initial recognition, thereafter no remeasurement. If I talk about financial liabilities, the classification is based on the instrument nature. Okay, so you have 6 instruments which are purely on the basis of FVTPL, that is derivatives, held for trading liabilities, liabilities designated as FVTPL, financial guarantees, contingent consideration, and continuing involvement approach. Apart from these 6, everything is at amortized cost. So here also reclassification is not possible because this is not involving any judgment. It's purely based on the nature of the instruments and therefore no reclass possible for financial liabilities. A reclass is possible for financial assets though. Why it is possible? Because there it depends on the business model test. So when you talk about the business model test, it is whether the business model is held to collect or whether it is held to collect and sell. Okay, so if there is a change in the business model, there is automatically going to be a change in the classification and you can do a reclass. So we saw the theoretical portions, okay, that is amortized cost to FVTPL, amortized cost to FVOCI, FVTPL to amortized cost, etc., etc. Okay. So now let us just pick up a couple of simple examples. You don't have to, really there are no many examples in the study mat as well. And from an exam perspective also, this is not so important. Okay, but nonetheless, thode se questions, it's just better that we can do it. So it won't take more than 15-20 minutes. Then we can dedicate the session to convertibles. Okay, I hope the next one is, yes, compound financial instruments. Okay, so coming to financial asset classification, reclassification. Okay, so now let us take case 1. You can note down side by side along with me. Okay, so case 1. On 1st April, amortized cost of the instrument is 1000. On 1st October, fair value is 1500. And now you are doing the reclassification. Okay. Case 1 is what? Amortized cost to FVOCI. Okay. So FVOCI means fair value through other comprehensive income. Okay. So now I want you to tell me, you will tell me the journal entry for this. Okay. I don't have to do any efforts. Okay. The instrument was measured at amortized cost initially. Thereafter, you have opted for FVOCI. So now you'll have to take the instrument to fair value. So what is the journal entry which you will pass? Okay. Good morning, Namrata. Good morning. Okay. So this Namrata, Panu, I suppose last class you were there till the very end. Okay. All right. So tell me, what will be the journal entry? This is reclass to FVOCI. Should not take much time. Come on, come on. Kaushik is not there today. Shriram to stopped attending. Jahnavi, are you there? Oh no, today's class won't be 5 hours. Don't worry. Okay. All right. What is the journal entry? Come on, come on. This is very simple. See, I have a fair value increase of how much? Fair value increase of 500. So therefore, my instrument should appear at fair value. So what is the entry that I will pass? Normally, you would pass the entry investment account debit 500 to fair value reserve, which is other comprehensive income 500. Okay. So this is the normal entry that you are going to pass. Okay. But institute does another manner of passing the entry. What the institute does is it passes the entry as, which is also not wrong. Okay. What institute does is bond asset at FVOCI debit 150 to bond asset amortized cost. We remove this 150 and then the gain goes to fair value reserve, other comprehensive income. So this is 50. Okay. So this is, sorry, not 50. What am I writing? My bad. 110. This is 1500. This is 1000. And this is 500. Okay. So institute does the second entry, but the first also is not wrong. Okay. The first entry also is not wrong. Basically, what institute wants to explain to this journal entry is that the bond asset, which is at amortized cost, no longer exists. So you remove that out. In its place, you have a bond asset at FVOCI. So that is 1500. The difference is going to fair value reserve. Okay, this is not sale or derecognition of the asset. It's merely changing the nature. Okay. If you remember, we had these type of entries under internal reconstruction as well. So there you used to pass the entry as equity capital account debit 100 to equity capital 10 to capital reduction 90. Okay, so basically the face value of the equity shares came down from 100 rupees to 10 rupees or 10 rupees to 1 rupee. Okay, so you would pass the entry equity capital 10 debit to equity capital 1 to capital reduction 9. Okay, so this was the form of entries which you used to take. Okay, where the equity capital at the old face value was debited and the new face value was credited. So these type of entries should not be new to you. Okay, we used to pass these type of entries earlier. Okay, all right. Coming to the next one. Okay, case 2. First April. Okay. Facts are same as above. But reclass to FVTPL. Okay. All right. Could you please help me with the entry? Could you please help me with the entry? Where are the others? Could you guys help me with the entry? Simple entry. Yes. Bond asset. FVTPL debit. 1,500. Two bonds. Amortized cost. 1,000. To fair value gain, which goes to P&L. Okay. Same entry. All right. So this entry, or you can pass the entry bond asset account debit to fair value gain in the P&L 500. I don't find anything wrong in that. Okay. Good morning, Kaushiki. Good morning. Okay. All right. Have you understood? Yes. So that takes care of case 2. That is amortized cost to FVTPL. So we have completed the first 2. Okay. Next one is FVTPL to amortized cost. Case 3. FVTPL to amortized cost. Okay. So we'll have to change the facts a little. So 1st April, fair value 1,200. 1st October, fair value 1,400. And then on 1st October, you take the decision to reclass it to amortized cost. You take a decision to reclass it to amortized cost. So now you tell me, what is the entry that you are going to pass? What is the entry that you are going to pass? First one, reclass is happening on 1st October. That means between 1st April to 1st October, there is a fair value movement. Yes. And that fair value movement should be taken to the P&L. Why? Because prior to 1st October, the instruments are measured at fair value through profit and loss. That is FVTPL. So prior to that, I will record the gain, and that gain I will take it to the profit and loss. Okay. So now 1st October, the first entry that we are going to pass is bond at FVTPL debit 200 to fair value gain P&L 200. Have we understood? Where are the others? Tushar. Then yes. So bond at FVTPL debit 200 to fair value gain 200. Now on 1st October, you are converting it into amortized cost. You are converting it into amortized cost. At what value will you convert? Sir, we'll convert at 1,400. But 1,400 amortized cost thodi hi hai. 1,400 is the fair value on 1st October. So, sir, what is amortized cost? You remember how we used to prepare amortized cost table? Opening balance, add effective interest, less repayments, giving the closing. So, opening plus interest minus payments give you closing. So, sir, we'll have to do this right from the beginning. Ideally, yes. Ideally, yes. Sir, why? Because to arrive at the amortized cost today, I need to know what was the effective interest rate when the bond was issued. I need to know what was the proceeds of the bond. And then I had to prepare an amortization table starting right from the earlier period and determine the balance as on 1st October. The standard says, sir, ye possible nahi hai. It's not practical. And why to dig up past data? Why to dig up past data? The standard gives you a very convenient exemption. The standard gives you a very convenient exemption. It says that as on the date of conversion, the fair value equals the amortized cost. So henceforth you apply amortized cost, but don't resurrect the amortized cost values prior to the date of conversion, prior to the date of reclassification. Okay. So therefore, what is the entry that you are going to pass? Bonds at amortized cost debit to bonds at FVTPL. 1,400. 1,400. Fair value on date of reclass is deemed to be amortized cost, is deemed to be amortized cost of the bond. $1,400. Now see, I started with 1,200. For this period, it was FVTPL. So 1,200, I booked the gain entry. So it comes to 1,400. And then I do a reclassification. Okay. And then I do a reclassification. By till 1st October for the 6-month period, it was FVTPL. Na? So I cannot avoid accounting that. Okay. If you take amortized cost at fair value, how will it vanish? Well, you adjust the effective interest rate, no? See, EIR is what? The effective interest rate is basically the IRR. And what is the IRR? Present value of inflow equals present value of outflow. So you determine what will be the present value of inflow, what will be the present value of outflow, equate both of them, it gets adjusted in the effective interest rate. So automatically that is going to match. Okay. Because there is only one balancing figure, which is the effective interest rate. Okay. All right. So that is case 3. Namrata, I hope you understood why it is 1,400. Okay. Next one is case 4. Case 4. Case 4 क्या बोलता है? Case 3 is done. Case 4. FVTPL to FVOCI. Okay. FVTPL to FVOCI. Okay. All right. Same facts. 1st April, fair value 1,200. 1st October, fair value 1,400. Why amortized cost? I explained, no, Namrata. See, the reclass is happening on this date, 1st October. Okay. So, let us understand. If the reclass is happening on 1st October, between 1st April to 1st October, there is a fair value movement. That fair value movement, I have to recognize it in I have to recognize it in the P&L? Yes or no? Because for that 6-month period, it was valued using, it was classified as FVTPL. So I first pass the entry, bringing it to fair value as on the date of reclassification. And after bringing it to fair value, I will do an amortized cost classification. So bonds at amortized cost debit 1400 to bonds at FVTPL, because now as on 1st October, after I pass the gain entry, the bonds will appear at 1400. Yes or no? They were appearing at 1200. I did a gain of 200. So therefore the bonds will appear at 1400. And because it is now appearing at 1400, the entire amount goes to amortized cost. If it were to be taken to the original amortized cost calculations, just imagine how much calculation you would have to do. You would have to go to the period when the instruments were issued. That time you will determine the proceeds, including the transaction cost, if any, calculate the effective interest rate at that point of time, and then you would do an amortized table calculation. So that whole process is very cumbersome. And that is why the standard has given some relaxation by saying that on the date of reclassification, the fair value on the date of reclass is deemed to be amortized cost of the bond. So that is why we have to take 1400. Okay. Is it clear? All right. So coming to the next one, FVTPL to FVOCI. Well, this is not very difficult. It's easy to do. Okay. Manageable. तो कैसे करेंगे इसको? How do I do this? Well, there is a 200 movement in fair value. So where will I take that, sir? You will take that to the P&L. Why P&L, sir? Because for that period, 6-month period, it is FVTPL. So the entry will be bonds at FVTPL debit, bonds at FVTPL debit, 200 to gain, fair value gain, sorry. Which goes to the P&L. So this is 200. This is 200. Okay. And then on 1st October, you do a reclass. And then on 1st October, you do the reclass. Bonds at FVOCI debit. At FVTPL. Okay. So this is now going to appear at 1400. Alternatively, you can club both the entries into one single entry. That is also permitted. Okay. Case 4. Case 5. FVOCI to amortized cost. Okay. FVOCI to amortized cost. FVOCI to amortized cost. Obviously, this is going to be debt. This is going to be FVOCI debt. FVOCI equity is never reclassed. It's a one-time irrevocable option. Okay. So FVOCI debt to amortized cost. Okay. That means what? Balance in fair value reserve exists. Balance in fair value reserve exists. See, it was FVOCI. So for every fair value movement, what did I do? I used to take it to the other comprehensive income. I used to take it to the other comprehensive income. That means there is a balance in fair value reserve. There is a balance in fair value reserve. That balance is now what I'm going to see what needs to be done with that. Okay. Now, 1st April fair value 1200. 1st October fair value 1400. Okay. All right. Now, until 1st October, it is FVOCI. So therefore, on 1st October, I will pass the entry for movement. So bonds at FVOCI debit 200 to gain on, to fair value gain. Other comprehensive income 200. Okay. Then the reclass entry. Bonds at amortized cost debit. Bonds at amortized cost debit 1400 to bonds at FVOCI 1400. Are you okay with this? Are you okay with this? Bolo yaar, are you okay with this? Yes. Yes. Now the question is, what do we do with the fair value reserve? इतने तक बात खत्म नहीं होती. There is a fair value reserve that is there. That fair value reserve is having some credit balance or debit balance as the case may be. Sir, it is only, what is the credit balance in FV reserve? What is the credit balance in FV reserve? Sir, it is 200. Sir, it is 200. No, it is not 200. 200 came now. Arey baba, 200 arose in the current year. Ye FV reserve jo hai, this FV reserve which is there, it is going on accumulating right from the first day. So, to put things in perspective, initial recognition for amortized cost, initial recognition is fair value plus transaction cost. Yes or no? The same thing holds true for which one? FVOCI. Fair value plus transaction cost. Okay. Now, after this, fair value movements. No entry will come in amortized cost, but in fair value reserve, but in fair value through other comprehensive income, you will consider the fair value movements. Means on initial recognition, I will record the same amounts, but thereafter under FVOCI, for every fair value movements, the movements will be taken to the other comprehensive income as FV reserve. Now, can I say that? Please pay attention. Abhi jara dhyan do. Okay. So 1st April, can I say that on 1st April, there would be a particular balance in FV reserve? Yes or no? There would be a particular balance on FV reserve? Yes. To that, add movement 1st October. There is a movement of 200. So the closing balance is basically nothing but all the movements from initial recognition till date of reclass. FV reserve, which is recorded in OCI, is accumulated movement on account of fair values from initial recognition till date. Are yes or no? Yes. So now please pay attention. Do I do a fair value movement here? Answer is no. Do I take a fair value movement here? Answer is no. That means the only difference between amortized cost and fair value through other comprehensive income is the fair value movements. Can you identify the fair value movements? Yes, in FVOCI we can, because I am creating a special fair value reserve. So fair value reserve is a representative of all movements that have happened after initial recognition till the current date. And therefore, can I say that, please pay attention, can I say that if I transfer the fair value reserve balance, if I transfer the fair value reserve balance to the bonds account, can I say that I can determine the amortized cost at initial recognition? Yes or no? Bolo yaar. If I transfer it to the bonds account, then can we arrive at the amortized cost at initial recognition? Yes or no? Yes, which is exactly what we are going to do. So on 1st October, bonds at FVOCI debit to fair value gain transfer to other comprehensive income. Bonds at amortized cost debit 1,400 to bonds at FVOCI 1,400. So where is this going to go? This is now the bond is appearing at 1,400. What is 1,400, sir? Technically 1,400 is the fair value today. And the difference between initial recognition and fair value today is nothing but total of the fair value movements during the period. And the total of the fair value movements during this period is taken where? The total of the fair value movements in this particular period. Fair value movements in this particular period is taken to fair value reserve, which is an identified reserve. So bas karna kya? You transfer the balance in fair value reserve to the bonds at amortized cost, and you are in a position to identify what is the amortized cost at the time of initial recognition. So therefore, fair value reserve transferred to bonds. Okay, so we'll pass the entry, last entry. Fair value reserve OCI. Okay, fair value reserve OCI. Yes, so that is transferred to bonds at amortized cost. Okay. I'm not sure of the balance at the beginning. So therefore, we cannot recognize it. Okay. We cannot, I don't know the full amount. Opening balance is not there. Only current year movement is there. So at the most, you can show that plus 200. Is it okay? Are we convinced about the reclass? Yes, Kaushiki, since FVOCI debt recorded in OCI, Reclassifiable. Absolutely right. Okay, absolutely right. You cannot, because here, see, I will not take it to the P&L because here I have an option. I have a better option available with me. Sir, what is the better option? I can actually go back and determine the original amortized cost. इसकी वजह से we will do the transfer, we will do the credit to the bonds at amortized cost. Okay, I have the ability. See, in the previous case, when it was FVTPL to amortized cost, in the previous case, can't see the last entry. Okay, 1 second. Okay, this is also on 1st October. Okay, so in the previous case, when it was FVTPL to amortized cost, that time there was no possibility for me to identify fair value movements kitne hai. See, right now academically probably it is fine, but practically you're holding on to a bond or something which is FVTPL for 1 year, 2 year, 5 years, 10 years. Then if that is the case, how am I going to identify bond movement ke liye what is the price? So the fair value reserve which is there, I cannot determine that in FVTPL because in FVTPL everything goes in one account, that is the profit and loss. But here I have the option of knowing how much is the actual fair value movement during the period under consideration. Yes, I need to know that. And because I know that, because I now know that, so what am I going to do is I can transfer it to the bond asset, and therefore I will arrive at the original cost on the date of initial recognition, and that would subsequently be taken care of at amortized cost method. Okay, there is no separate reserve in FVTPL. Okay, so Kaushiki, did you follow why we have not taken it to the P&L? We cannot take it to the P&L. We cannot take it to the P&L because a better alternative exists. Okay, all right. Next, so that takes care of case 5. Case 6, FVOCI to FVTPL. Okay. FVOCI to FVTPL. Okay. All right. Same facts. 1st April, 1200. 1st October, 1400. And now I am reclassing the bond from FVOCI to FVTPL. So now I need you to tell me. How do you propose the reclassification? How do you propose the reclassification? Sir, सबसे पहले तो I will record the fair value gain. Where will you record? Sir, I will record it at FVTPL. No, you have to record it at FVOCI since on 1st October you are moving it to FVTPL. So abhi ke liye it will go under other comprehensive income. Okay, so the entry that you are going to pass, will be 1st October, bond at FVOCI debit to fair value gain, other comprehensive income, 200. Then 1st October, we do a reclass entry. Bond at FVTPL debit bonds at FVTPL debit, at FVOCI, to bonds at FVOCI. Okay. Am I missing out on something? Am I missing out on something? Fair value reserve. I am missing out on fair value reserve. I am missing out on something. What is that something? Fair value reserve. Fair value reserve. Can I take this to the bond at FVTPL? Answer is no. If you take it to the bond, the problem is, you know what? The problem is fair value through profit and loss will not be reflected. The fair value of the bond will not be reflected if you take it to the if you take it to the FVTPL. So therefore directly take it to the profit and loss account if it is reclassifiable. If not reclassifiable, then you will be taking it to reserves. Okay, either of the two options are correct. Okay, so 1st October fair value gain, sorry, fair value reserve debit. How much is it? I don't really know. Okay, fair value reserve, other comprehensive income, to bonds at amortized cost. Sorry, not bonds, to P&L. To P&L. If it is reclassifiable. If non-reclassifiable, take it to general reserve or retained earnings, whatever it is. Okay, so fair value reserve to P&L. If reclassifiable. Okay, all right. Done. So did you understand the reclass kind of comfortable? Yes, very simple. You don't get a question on reclass because you have so many better things to do in your life as far as financial instruments is concerned. And institute also has a plethora of options for making your examination paper little difficult. Okay. So in all probability, you will not encounter a question on reclassification, but because it was specifically there, and in between the queries I saw that one or two students asked, sir, can I do reclass from one method to another? So for those students and for the fact that it is permitted, we have discussed it. Is it okay? Anybody has any doubts here? Anybody has any doubts in reclass? Please don't take a lot of time for reclassification. Okay. You know the broad principles, that is fine. I gave the reasoning also for each of them. So therefore you can take a call. Okay. All right. If non-reclassifiable, then you can take it to retained earnings. Okay. If it is non-reclassifiable, you can take it to retained earnings. Okay. All right. But remember, FVTOCI for equity can never be reclassified. Okay. So that you will have to remember. Okay. All right. Just give me a minute. Somebody at the door. All right, fine. Okay. So that takes care of the unit 2 that we were to discuss. Okay. And now we come forward to the most important part of our session. Okay. On financial instruments. Okay. So off market transactions and compound financial instruments together, you can expect at least about 10 to 14 marks only from these two sections of financial instruments. Okay. Every exam it has come. Every exam it is a hot favorite of the examiners. Okay. And then a little bit of derivative accounting is there, which is kind of important. Okay. So these three things are extremely important. Okay. So, in fact, I will rate compound financial instruments as even more important compared to the other two. Okay. But yeah, so whatever you revise in financial instruments, don't leave off-market transactions, don't leave compound financial instruments, don't leave derivative accounting. Okay. So coming to financial instruments, compound financial instruments. What is compound financial instrument? An instrument that exhibits multiple features. Multiple features means what? Compound is what? Compound is a combination. Okay. So you have something known as simple financial instruments. That is what we have been doing so far. Okay. Bond, debentures, fixed deposits, equity shares, all these are simple financial instruments. Okay. Trade receivables, all these are simple financial instruments. Simple means what? Only one feature is there. It is either an obligation to deliver cash or a right to receive cash or equity instrument of another equity or my own equity instrument. So basically there is only one feature in the instrument. And because there was only one feature in the instrument, they were simple financial instruments. Though the accounting is not very simple. The accounting may not be simple, but for the purpose of classification, they were simple financial instruments because keval ek, there is only one classification that was required to be done. But now we are having compound financial instruments that exhibit multiple features or features of multiple instruments. So for example, an instrument could exhibit equity features also as well as liability features also. So how do we do the accounting is what we are now going to study. So I will take you through one example. You can note down the example, but this example is going to be the base for understanding all the questions. Okay. So if you are sure of the example, the confidence you get, the understanding you get, I don't think you will have any difficulty in solving the questions in the study module. Okay. I have spoken to the institute. There may be a spillover of the sessions into June because I feel that the time is not very, what you can say, there is not sufficient time to do a detailed question solving. So I would love to solve more and more questions with you. So there could be a spillover in June. Okay. So you'll be posted about it, but let us see. Okay. So coming to compound financial instruments. Now let us take, we are in the books of whom? Books of issuer. Books of issuer. Okay. Now, when I talk about books of issuer, let us take a simple example. Issue price rupees 1 lakh. Face value, this is also 1 lakh. Okay. Number of bonds, 100 bonds. So I have issued 100 bonds with a face value of 1000 each at rupees 1000. So that is 1 lakh. Okay. Coupon rate is 6%. Term is 5 years. Okay. Term is 5 years. Okay. All right. Now Yes, mandatory returns, we have done all of that. Okay. Now coming to our what you can say, coming to this, you tell me, nothing else is given. Nothing else is given. If this is the data given to you, forget the heading and everything. Okay, you are in the books of issuer. There is a bond with issue price of 1 lakh. Coupon rate is 6%. Tenure is 5 years. If this is the data given to you, you tell me, what are you going to classify this as? You are in the books of the issuer. You are in the books of the issuer. What are you going to classify it as? What are you going to classify it as? Financial liability. Absolutely. See, if nothing is given, what will be your thought process? Sir, I will pay the interest also and I will redeem it also. So I have a defined obligation for the stream of payments as well as the bullet repayment at the end of the maturity. So therefore, I would classify it as a pure financial liability. I would classify it as a pure financial liability. Now let us introduce one more thing. Okay. Conversion feature. Conversion feature. Now, if I talk about conversion feature, we introduce the feature that one bond equals 10 shares. Okay. For every bond that you are holding, it will be converted into 10 equity shares. It will be converted into 10 equity shares. Okay. And this is mandatory conversion, not optional. This is mandatory conversion. Okay. So if it were AS13, please pardon me that I every time take you through AS13, but that is how I want it to be done, because you will be able to identify what was the fallacy that was there in the accounting, or what was the fallacy that was there in the accounting. And then how Ind AS 109 has sought to remedy the fallacy that was there earlier. Okay. So now if it was AS13, year 0, sir, I would pass the entry bonds account debit 1 lakh. Sorry, bank account debit. Bank account debit 1 lakh to convertible debentures. And where would I place it? Sir, I would place it under liabilities. Are yes or no? यही करते थे ना हम लोग. We used to record the instrument as a liability. Sir, क्यों liability? Name was there ना, नाम में लिखा था debenture is a liability. Debenture is a liability, so it will be a liability. Okay, so bank account debit to convertible debentures liability. Years 1 to 5. Years 1 to 5. Okay, how would you pass this? Well, it would be based on the coupon rate. So interest account debit to bank. Okay, so this would be 1 lakh into 6%. 6,000. You would do this for 5 years. 5 years. Yes. And at the end of the 5th year, when conversion would happen, you would pass the entry year 5. Convertible debentures liability debit 1 lakh to equity share capital. How many bonds am I having? 100 bonds. Each bond convertible into 10 shares. So 1000 shares into 10 face value if you assume. This will be 1000. Wait, how many shares? 1000. So this will be 10,000. And then to securities premium. Yes, this was the earlier entry that you were passing. Are you able to recollect this? Are you able to recollect? Yes, others who are watching, are you able to follow? Yes. Only two people interacting with me. Where are the others? Tushar and Viraj Desai is not there today. Viraj, are you there? Panu, are you there? Yes. Swaminathan, are you watching? Vikalp Jain, are you able to follow? Yes. Are you able to recollect? So this was what you would record. However, I see that there are some inconsistencies with this. Sir, inconsistency bole to something is not right. What is not right? First one. I am only following the legal form. Okay, that means I am not going for substance over form. I am going only for form accounting. So the form is that a debenture has been issued. So the debenture issued is taken entirely as liability. And then जब convert होगा तब convert करेंगे to equity. Yes or no? So that is the attitude which is there. So therefore I would take it to the equity at the 5th year on actual conversion. But you tell me the fact that this liability will never be paid, is it known to you initially or is it known to you at the end? Kab malum hai aapko? When are you aware that this debenture liability is convertible into shares? Are you aware at the time of issue itself, or are you getting aware, are you becoming aware of it at the time of redemption? Kab malum hai aapko? When do you know that? Initially. तो जब initially अपने को मालूम है, why do I have to take it as a liability? Initially only I should split it. अरे बाबा, see, the 1 lakh rupees is never payable in the first place. And जब 1 lakh is never payable in the first place, it means there is no contractual obligation to deliver cash for the principal amount of rupees 1 lakh. And if there is no contractual obligation to deliver cash, then 1 lakh cannot go ahead and you cannot take 1 lakh into liability. Because उसके सामने तो हम equity ही दे रहे हैं. We are giving only equity. Okay, so that is the major issue that we are having. That is the major issue that we are having. However, is there a contractual obligation for 6,000? Is there a contractual obligation for 6,000 to deliver cash? Answer is yes. 6,000 to cash deliver karna hi padega. That is mandatory. Okay. And then if the reader of financial statements looks at the balance sheet, he will see only debt. He is not going to see that there is any potential equity in the capital structure. So there you had to have a separate capital gearing ratio for covering such kind of scenarios. Okay. At the same time, you cannot have said at that point of time, हम सब कुछ equity में डाल देंगे. अरे no, you cannot. And therefore, we had to introduce a hybrid accounting. And this hybrid accounting is the substance for what we call the compound financial instruments accounting. So this is basically a split accounting that we are going to do. The thought process under the GAAP regime, the thought process under the AS regime was one instrument, one characteristic. One instrument, एक नाम. एक instrument, एक नाम. एक instrument, एक नाम. आपने डिबेंचर इश्यू किया, it is a liability. You issued equity shares, it is equity. You acquired bonds, it is investment. So one instrument, one name. That was what was done. However, Ind AS questions that very premise and says that if the nature of settling the instrument is different, jahan pe you are having one flow in the form of cash and the principal say in the form of equity, then how can you say that it is a pure equity, or how can you say it is a pure liability? It's not. It is not pure equity. It is not pure liability. It is a combo offer of both of them. आपको थोड़े features equity के मिल रहे हैं, आपको थोड़े features liability के मिल रहे हैं. You are getting an instrument that is having part equity features and part financial liability features. And therefore, Ind AS 109 tells us it is obligatory upon you to separate them. It is obligatory upon you to separate them. Okay. Now, the question is, ठीक है sir, बता दिया आपने separate करना है. Now, how do I separate it? How do I separate it? Sir, separation का क्या है? We have the liability component, which is the interest that we are paying. So basically, the interest we take it straight away into liability and balancing figure into equity. इतना आसान नहीं है. It is not so simple. It is not so simple. Okay. So now we are having an instrument with 6,000 per annum as cash outflow. We are having an instrument with 6,000 per annum as cash outflow and a conversion feature attached to it. So basically, my bond which is there is a combination of two instruments. My bond is a combination of two instruments where in the market, suppose I have a bond that gives year 1, 2, 3, 4, 5. I go to the market and check. For a market bond, 6,000 each is your inflow. There is no conversion feature in this. No conversion. You have an instrument that pays you 6,000 per annum for a period of 5 years. As compared to that, you have a piece of paper, which is basically the bond document, which is a convertible bond. And what is this convertible bond saying? Year 1, 2, 3, 4, 5. Acha. In each of these years, what are you going to get? Sir, I will get 6,000 cash. Apart from this, what are you getting? At the end of year 5, there is a conversion also that is included. So, I have two methods of doing the split. Understand carefully. Ye zara important. I have two methods of doing the split. I have a financial liability whose value is, say, X, pure financial liability. I have an equity feature whose value is Y. That is the convertible feature whose value is Y. The total of it becomes my instrument, which is Z. And this is issued for 1 lakh rupees. Z is issued for 1 lakh rupees. Now I'm asking a logical question. कूद के जवाब मत दो, सोच के जवाब दो. Okay, don't jump to conclusions. X is the market value of the bond. Okay, X is the value of a bond with no conversion feature. Y represents the conversion feature. Between X, which is a liability on account of a continuous flow of cash, and Y, which is the fair value of the conversion that will happen, between these two, which is more reliable? Or which is easier to calculate? Or which is more, what you can say, less prone to judgmental errors? what is less prone to the bias of the valuer? Okay. What is simple to calculate? Is it the value of the liability, which is in the form of interest cash flows, or is it the equity, which is a convertible feature that is added in the bond? Between both of them, what is easily computable? What is easily computable? Between both of them, what is easily computable? Sir, it is X. It is X. Sir, why X? Why not the convertible feature? See, the convertible feature will be based on certain variables. Sir, variables like what will be the future performance of the entity? What is the weighted average capital it holds? What will be the dividends it could declare if you are following a dividend discount model? What will be the beta factor of this company? If it is an unlisted company, how do I calculate? What will be the equity capital under the capital asset pricing model? All of these instruments entail huge amount of judgments. You could follow a Black and Scholes model also, which is a mathematical simulation. However, in all these cases, in all the cases, for valuing the equitable feature, the equity feature, I cannot go without bias. I cannot go without bias. Whereas the market value of the bond is easy because cash flows are defined, rate is defined. So everything is defined from our end. And that is why what the standard prescribes and what we are going to do is we will always calculate the value of the liability. And the value of equity will always be a balancing figure. The value of equity will always be a balancing figure. Sir, why it will always be a balancing figure? Why it will always be a balancing figure? Because valuation of options is an area prone to bias. And therefore, we presume that, see, initial recognition happens at fair value. So this 1 lakh is a fair value. I'm doing a fair valuation of X. So therefore, Y always has to be fair value. There is no doubt about that. So the standard says don't value equity and liability component independently. There will be a case where if you do them independently, it will never come equal to 1 lakh. You have to find out a way that it comes to 1 lakh. It's not going to come easily to 1 lakh rupees. Okay. So therefore, aap kya karoge? You know the issue price. You know the fair value of the liability component. Equity is going to be the balancing figure. Are you able to follow? Are you able to follow? Okay, so I have a doubt. I have a doubt from Mr. Vinay Kumar. Sir, reclassification is done on the reclass date. If reclass day is the first day of the first reporting period. Correct. So you mean to say that the reclassification happens on 1st April instead of 1st October. In our examples, we took the reclass on 1st October. Okay. If the reclass happens on the first day of the reporting period, following changes in the business model, there is no need for you to go to 1st October. Na? Whatever movements are there up to 1st April, only that you consider and do a change in the accounting. Okay. So the choice is yours. All right. Okay. Fine. So therefore, my instrument, now please pay attention. My instrument is interest cash flows plus convertible feature. The market instrument is only cash flows, no convertible feature. So market plus, interest plus convertible minus interest gives you the value of the convertible feature, gives you the value of the convertible feature. So if I go to the market, I will not ask the price of a convertible bond because wo to mere paas hai. I am already having a convertible bond price. So what I will ask is, a similar bond without a conversion feature. a similar bond without a conversion feature, what is the expectation? What is the expectation of return on such bond? What is the expectation of return on such bond is what I will be asking. And you get the answer that the expected return is 10%. You get the option that it will be, you get the answer that for similar bond, which is giving only a continuous stream of interest payment, which is giving only what you can say a continuous stream of 6,000. We expect that at least 10% should be our return. We expect that at least 10% should be our return. Okay. So if that is the case, then what am I going to do? This 10% represents the rate which I am willing to shoulder. I mean, the expected rate in the market for these type of instruments. So I will discount my present value of cash flows. I will discount my present value of cash flows to determine at the price point at which I will have to recognize the liability component. So let us proceed to calculate. That is going to be 6,000 into present value annuity feature 10% for a period of 5 years. Is there a principal repayment here? Answer is no. I'm looking for a continuous stream of interest cash flows only. Okay, so into PVAF. So this comes 10% for 5 years. This comes to 3.7908. So that is 6,000 into 3.7908. How much does that come to? Where is my calculator? 22,744. 22,744. This is 22,744. That is the present value of the bond without a conversion feature. The present value of the bond without the conversion feature. And if I talk about the convertible bond right now, okay, how am I going to take it? Well, that is going to be the balancing figure, and therefore, since it contains interest plus conversion, the price of a convertible bond will typically be higher. The price of a convertible bond will typically be higher than what is there for the market bond. The issue price terms I'm telling in absolute terms. Okay. So see, where is the principal repayable? Why are you getting the principal back? Answer is no. So I will go to the market and I will find out if the same option with only the payment of interest every year, what is the effective interest rate on that? See, I have to get the data as close to comparison as possible. If I look for a data that has interest payment included in it, then that is not going to serve my purpose. That is not going to serve your purpose. What is going to serve your purpose is, in your bond, the liability feature is only up till years 1 to 5. That's it. So in that particular period, you have to find out what will be the market rates of interest on a similar bond which is working for a period of years 1 to 5, Have you understood? Yes. Have you understood? So if I have to again go back to X, Y, and Z, X is now standing at 22,744. X is now standing at 22,744. And if X is standing at 22,744, what is Y? Y to independent is not there only. Y is not there independently. Y is ultimately going to be a balancing figure plus Y plus Y is equal to how much? Is equal to how much? This is equal to the issue price of 1 lakh. And therefore, Y is equal to 1 lakh minus 22,744. This is equal to how much? This is equal to 77,256. 77,256. So this becomes your equity component. Did you understand? Yes. Did you understand, everyone? Bolo yaar, what is 77,256? This is the premium that you have paid as compared to a bond which does not have any convertibility feature, okay? And therefore, 77,256 is the overpayment which you made. Shock hai kya? You have a lot of money? No. मेरे को share मिल रहे उस company के. I am getting shares for that in the future, and therefore I am willing to pay a slightly, what you can say, I'm going to pay a higher amount because I'm going to get equity shares in the future. The market instrument does not give me equity shares. Okay. All right. So therefore, your equity component is 77,256. Liability component is 22,744. Total comes to 1 lakh. Total comes to 1 lakh. Are we understanding? Are we understanding? Yes. Bolo. Kaushiki has confirmed. Vinay Kumar has confirmed. Yes. Okay. Fine. How do we do the accounting? Illustration 3. Illustration 33. Okay, sorry, my mistake. I have a query to explain a particular question. 32. Okay, we'll discuss it. Don't worry. Questions will come later. Okay. All right, fine. So now, what will be the scheme of entries? Sir, journal entries pass karte. Yes. So year 0. This is when you issue the instrument. Bank account debit. How much? 22,744, 77,256 or 1 lakh. What is it going to be? What is it going to be? 77,256, 22,744 or 1 lakh. I am the issuer. Okay. I am the issuer of the instruments. 1 lakh. Okay. This is absolutely right. You are going to get 1 lakh in your bank account. 2. Liability component of CFI. This is going to be 22,744. To equity component of compound financial instrument. 77,256. सही है ना? 256. Yes. Are we able to follow? Yes. 77.4 or 77.2? It is 77.256. 256, not 456. Okay. Years 1 to 5. Years 1 to 5. Entry pass karoge for what? Sir, interest. Can I pass the entry interest account debit to bank 6,000 rupees? Can I pass the entry as interest account debit to bank 6,000 each year? Yes or no? कर सकता हूं क्या पास? Can I pass the entry as 6,000 interest? I cannot. I cannot pass it at 6,000 because 6,000 is a coupon repayment. But you have to calculate based on effective interest because your liability component is 22,744. It's not 1 lakh. So the interest that you have to calculate is going to be 22,744 basis only. Acha, without preparing amortization cost table, मेरे को एक बात बताओ, tell me one thing, what will be the value of this equity at the end of year 5? Don't calculate, don't solve, logically socho, at the end of the tenure, at the end of the 5 years, what will be the amount that is payable or what will be the value of the loan amortization table? Tell me. What will be the value? $1 lakh. 22,744 will jump to 1 lakh with only 10% at the rate of 10% per annum for 5 years. That is not very logical. Yes. 22,744 kahan tak pahunchega after 5 years? 77,256. Answer is not right. Come on, yaar. Think logically. What is 22,744? How did I come to 22,744? I came to 22,744 by discounting the stream of interest of 6,000 over a 5-year period at the market rate of 10%. So, ultimately, if I now start working on the opposite, that means I now have opening balance. I now have to unwind the discount and the interest. At the end of the tenure, how much is it going to come? At the end of the tenure of the instrument, how much will be the balance? The balance is कैसे होगा 30,000? वो 30,000 नहीं होगा ना. Every month you are paying 6,000 rupees. Yes. Every month you are paying 6,000 rupees. So at the end of year 5, वो zero हो जाएगा. Absolutely right. It's going to be zero. Arey, every year you will pay 6,000 rupees. You are accruing interest. Why are you accruing interest? Because you are settling it in cash. You are making a payment in the nature of coupon. So at the end of year 5, after year 5, will there be any further payments? Answer is no. That means at the end of year 5, the entire liability obligation should be settled. Answer is yes. And if entire liability obligation has to be settled at the end of year 5, what will be the closing balance? वो zero हो जाएगा. 22 नहीं, 77 नहीं, 1 lakh नहीं, 30,000 नहीं. It will tend to zero. See, this is what is important for us to understand. We need to know where my figures are going to move forward. Because if I don't understand that, there could be a chance that I'm going wrong somewhere. Okay. So financial liability at the end of 5 years is going to be zero. Is it okay? Yes. So now let us prepare a loan amortization table. Year, opening, effective interest rate, and lastly, repayment. And closing. Okay. So year 1, 2, 3, 4, 5. Opening will be how much? 22,744. EIR 2274. Prepayment 6,000. $1,902. 6,000. Yes. Did you understand? Financial liability component becomes zero. Financial liability component becomes zero. Yes. Did you understand the loan amortization table? Yes or no? Quick. Did you understand? Everyone. Janvi, beta, did you follow? Kaushiki, did you follow? Namrata, did you follow? Tushar, did you follow? Vinay Kumar, did you follow? Okay. Everybody followed. So now what will be the journal entries for years 1 to 5? I'll not write it, but quickly tell me what will be the journal entry for years 1 to 5. I will pass the entry finance cost, which goes to the P&L account debit. Credit what? What am I going to credit? What am I going to credit? Bolo, fatafat bolo. What am I going to credit? What am I going to credit? Finance cost debit. You will do that. What am I going to credit? I will be crediting the liability component of the compound financial instrument. I will credit the liability component with how much? With 2274, 1902, 1492, 1042 and 546. So this is what you are going to recognize as finance cost. Repayment will be liability component account debit to bank 66,000 each year. So ultimately your closing balance is going to be 19018, 14920, 10412, 5454 and finally it comes to 0. Finally it comes to 0. Is it okay? Yes, समझ में आ गया. So I will not be passing entries years 1 to 5. Year 5, when the conversion happens, year 5, when the conversion happens, what is the entry that you will pass? Year 5 conversion. Well, the entry that I will be passing is equity component of CFI 77,256 to equity share capital. How many bonds are getting issued? Oh, sorry, 100 bonds into 10,000, 10,000. To $67 to $56. Are you able to follow? Are you able to follow? Yes. Did you understand the manner of split accounting, reason for taking market-based rates? Yes. Bolo, everybody followed? Yes. Yes. Okay. Now, let us slightly modify this question and you will solve it for me. Think. Okay, think. Instead of compulsorily convertible bonds, okay, or debentures which have a compulsorily convertible manner of settlement, we now shift it to optionally convertible. We now shift it to optionally convertible. Okay. We now shift it to optionally convertible. All right. And we now shift it to optionally convertible. So the effective interest rate continues to be at 10%. So what I want you to do is, I want you to try and get me the liability component as well as the equity component. Think and answer. The instrument is convertible. The instrument is convertible, but at the option of the holder, not the issuer, at the option of the holder of equity shares. Okay. So now I want you to find out holder of the bonds. Sorry. Okay. Holder of the bonds. So you will now help me in doing the calculations. Okay. Yes. Just start to try. Let us see. Even if you go wrong, no problem. But I need you guys to try. Okay. Just check it out. Okay. Yes. Anybody tried to get the value? Anybody tried or still working? Okay. The first thing is ask yourself a question. I have an instrument. I have an instrument, and this instrument is convertible at the option of the holder. That means, suppose Reliance Industries issues you a bond. The bond is convertible to equity shares, but it's not compulsory. At the time of settlement, that's right. Okay, Janvi, that's absolutely right. Okay, very good. So now, at the time of, after the maturity period is over, when it comes to repayment, you, the bond holder, has the option to decide whether I want cash for the bond or whether I will say, no, I don't want cash. I need the equity share. I need the equity share of Reliance. So can I say that it is something like this? Years 1 to 5, cash for interest. Year 5, principal in cash plus option to convert. Can I say that my instrument looks something like this? Yes, where I am going to get interest in cash, and in year 5, I have the option to ask for the principal in cash, or I can ask for equity shares. Are yes or no? Yes or no? Bolo yaar, it is optionally convertible. It's not mandatorily convertible. It is optionally convertible. So are you able to understand the nature of the instrument? Yes? All right. Now, let us proceed to the next step. I first have to identify how to separate this. Okay, how to separate it. So let us understand with the help of the same example that we did. Okay, the same example that we did. Okay. I am having an instrument. One second, please. क्या हो रहा है यार इसको? Okay. Cash for interest, rupees 6,000. Okay. Principal in cash, this is at par, rupees 1 lakh. Okay. So now, can I say that in the market, I will look for an instrument that is a non-convertible debenture? Yes. So basically what I am having is a non-convertible debenture wherein I am getting cash 6,000 per annum as interest. I am getting principal 1 lakh, and additionally I am having an option to convert, or rather I can say option to buy. How many shares? Option to buy how many shares? 100 bonds into 10 shares, 1,000 shares. Option to buy 1,000 shares. Yes. So can I say that my instrument is a combination of both of them? Can I say that my instrument is a combination of a non-convertible debenture with an option to convert the principal into equity. Yes or no? So this total gives you the instrument that I am now holding. This gives you the instrument that I am now holding. What is the instrument 3? Years 1 to 5, rupees 6,000 per annum. Year 5, rupees 2, option to buy shares. Instrument 3 is a combo offer. Are you able to follow? Bolo yaar. Yes, are you able to follow? So therefore, option to buy shares, can I say that this is a derivative? Sir, derivative Q. A derivative should have 3 features. What are the 3 features? Value depends on an underlying. In this case, the option to convert, does it depend on the underlying? Answer is yes. It depends on the underlying equity shares of Reliance. So your option starts to get more and more valuable as the share price of Reliance starts to increase. So can I say value of your option depends on the underlying? Answer is yes. Can I say that settlement happens in future? Yes. Settlement after 5 years. So it happens at a future date. And third one is initial payment is nil or insignificant. Have I paid anything to acquire the share? Answer is no. I paid to acquire the convertible bond, which includes the option to convert. So therefore, is it meeting the definition of a derivative? Yes, it is. And because it is closely related, it is forming a part of the non-convertible debenture contract. It is closely related. It is built into that contract. It is etched into that contract. It is carved into that contract. It is stuck to that contract. It is bundled with that contract. We call it an embedded derivative. कौन सा derivative है ये? It becomes an embedded derivative. It is a derivative which is embedded into the contract, which is stitched into the contract. You cannot separate it from each other now in instrument 3. तो इसको हम लोग बोलते हैं, we call this as an embedded derivative. Why embedded? It is stitched into the contract. It is bundled along with the non-convertible debenture. You cannot go to Reliance Industries, which is issuing the bond, and say that I don't want the option to buy the shares. I want only the non-convertible debenture. Reliance will say, nah. This time our option is coming, our issue is coming with the option to buy. And anyways, we are giving you the choice to redeem, right? So you tell me, what is the problem? आपको कैश चाहिए ना, that option is given to you in any case. So therefore, we are going to give you this. It's stitched along with that. तो इसको हम लोग बोलते हैं embedded derivative. And embedded derivatives, subject to certain conditions, have to always be separated from the host contract. They have to always be separated from the host contract. This is my host contract. The host contract is the base to which the derivative is getting attached. It is the structure to which the embedded derivative is getting attached. Okay. So you have a host contract, which is a non-convertible debenture. To that host contract, you are adding equity shares purchase option. You are having equity shares purchase option. Is it okay? So it becomes an embedded derivative. And as per Ind AS 109, the embedded derivative must be separated from the host contract, subject to certain conditions which we will see when we do embedded derivatives. But as of now, we will have to separate this. So if I have to separate it, how do I separate? Well, you have two things with you. One is, do I know the issue price of instrument 3? Yes. I know that this is 1 lakh. I know that this is 1 lakh. So you have to pay 1 lakh for buying this instrument. Okay. Now the question is, which value is reliable? Determination of the fair value of the non-convertible part is more valuable or more reliable, or is it the option valuation? Option valuation means you have to go for the Black and Scholes model or the binomial model where there is a lot of bias. So clearly the valuation of the non-convertible instrument is far more reliable, easy, and therefore instrument 2, the option to buy the shares, this becomes a balancing figure. This becomes a balancing figure. Let us now presume that the 10% rate of interest continues. Let us now presume that the 10% rate of interest continues. Okay. So basically you need a bond that facilitates at least a 10% return on the investment. That facilitates at least a 10% return on investment. So therefore, how do I calculate that? How do I calculate that? Well, fair value is present value of cash outflows. For the issuer, it will be an outflow, right? So outflow kitna hai bhai? 6,000 per annum. Yes, 6,000 per annum multiplied by present value annuity factor 10% for 5 years. So that comes to how much? That comes to 3.7908. Okay. Plus what else? Well, you will be having the return of the principal also. So 1 lakh into present value factor 10% 5th year. 10% 5th year. So this comes to how much? This comes to 0.6209. And if I do this, 6,000 into 22,744 plus 62,090 plus 84,834. Some of you got 837, 836. Both are acceptable. Okay, both are acceptable. Both of them are acceptable. Okay, that's right. All right. So therefore, value of option is equal to value of option is equal to how much? 1 lakh minus 84,834. So that is 15,166 or 4, whatever be the answer. Okay. 15,166. Okay. Yes. All right. Now, without doing the loan amortization table, tell me at the end of year 5, 84,844. How much will it grow to? Or how much will it decline? Don't prepare amortization table. मेरे को धोखा मत दो. You start preparing amortization table, you will not get the concept. Get the concept first. Amortization table is what I would call a mere calculation aspect. Think, exercise your brains and tell me 84,800 something after 5 years, what is it going to be? Yes, Absolutely right. It will increase and become 1 lakh rupees. Why 1 lakh? Array, at the end of the 5th year, दो option है. Either pay 1 lakh. If we have to pay 1 lakh, it must grow to 1 lakh in the first place. So it will grow to 1 lakh with the help of the effective interest rate of 10%. Okay. And even if I have to convert, even then it has to grow to 1 lakh. Even then it has to grow to 1 lakh. Yes or no? So ultimately it should grow to 1 lakh. Okay. See, I need you to think, because क्या होता है एग्जाम में फट करके you will do the amortization table and come. But I need you to foresee the circumstances. I need you to foresee what can happen out of the way in case it does. Okay. So therefore the entry, the loan amortization table looks something like this. Year 1, 2, 3, 4, 5. Opening. Okay. So now 8483 coupon 6000. So 84, 834, 87, 317, 8732, 90049. $93. Okay. So 9641. Everybody got the amortization table correctly? Yes. Okay. All right. So year 0 entry will be Okay, 15,166. Okay. All right. Years 1 to 5, this will be the interest you record, and then the coupon repayment is what you will be recording to give the closing balance. Years 1 to 5 is done. Year 6. Yes, year 6. Not year 6, sorry, year 5 only. End of year 5. Liability component. So these are the balances in our ledgers on the date of maturity. Okay. That means now either they could be a reclass or there could be a movement to the P&L. Okay. Directly. So now tell me, what is this going to be? Okay. I'll have two options. Holder exercises redemption. Holder exercises option to convert. Okay. So if holder exercises option to convert, what is the entry I'm going to pass? Liability component debit 1 lakh. Equity component debit 15,166 to equity share capital to equity share capital 10 lakhs, and then 10 lakhs, no, 10,000, sorry, to securities premium. Okay. This is the entry that will be passed. Okay. On settlement, if you exercise the option to convert, if you exercises the option to convert. Okay. So basically, when the holder exercises the option to convert, what is the holder doing? The holder is foregoing his liability, and in return, he is getting equity shares. That is why liability component is debited. Usko shares and cash dono nahi milega. He will not get maturity proceeds also and equity shares also. No, it is either of the two. So if he opts for conversion, then the entry will be debiting the liability, because liability foregone is the consideration for equity shares issued. Are you able to appreciate? Yes, liability foregone is a consideration. Liability foregone is a consideration for equity shares which will be issued by Reliance to these, to these shareholders. Next one is holder exercises option to redeem. Acha, if you talk about redemption, then liability component debit, liability component debit 1 lakh to bank. Yes, to bank 1 lakh. Then second one is equity component debit, equity component debit to retained earnings. Okay. All right. Now the question is, sir, why are we transferring equity component to retained earnings? Because it is a transaction between the owners. Okay, owner to owner transaction, and that is why we take it to the retained earnings. Can I combine both the entries? Definitely you can. Definitely you can. Okay, as long as the balances are the same, I don't see why you cannot combine. Okay, so this is what is there for compound financial statements, uh, theoretical perspectives. Okay, theoretical perspectives. Okay, any doubts? No doubts? Everyone, Kaushiki, absolutely clear. Jahnavi, absolutely clear. Namrata, crystal clear. Vinay Kumar, what is your doubt? Any doubt in this section so far? Yes. What about the others? Yes. Is it clear, everyone? Yes. All right. So that is your initial part on financial instruments, the compound financial instruments. Why do we do the conversion? How do we arrive at the equity component? Okay, these 2-3 things we have already checked. Okay, so we take a 10-minute break. After the break, we will do just one question for today and wind up the session. Okay, the retained earning thing seems a little off track. I will explain after the break. I will explain after the break. Okay, yeah, we take a 10-minute break and continue later on. Okay, yeah. Okay, guys. So the scheme of entries, the calculation, everybody said it is absolutely clear. But now there are some one or two things left to be ironed out. Okay. So the first one is why am I transferring the balance in the equity component to retained earnings? Okay. See, you remember when we did something similar earlier also. Zara yaad karo, try to recollect. We did something similar in ESOPs with cash settled options. Okay. ESOPs with cash settled alternative. You remember that? Yes, you had an instrument which you issued to your employees, and the employee had the choice whether he wanted cash or whether he wanted equity shares. How did you do the accounting for that? Well, the accounting for that was done on the basis of assuming that the employee will demand cash in the future, because see, ultimately it is a hanging sword on the company's head that he can demand cash at any point of time. So suppose he demands cash, I should have a liability seated in my books as on the date of settlement, and that is why we would recognize a liability. But suppose okay, and when he demands cash, the liability account will be debited and transferred to the bank account. The problem arises with the SBP reserve which I had created there. The SBP reserve cannot continue because the options no longer exist. And because the options no longer exist, what do I do with that SBP reserve? The standard was telling transfer it from one component of equity to the other. So I would transfer it from SBP reserve to retained earnings and complete the accounting. Okay. The same concept applies here. My holder of equity instruments is not an employee, but he's having the option to convert. So suppose to convert or to redeem, whatever it is. So suppose he chooses the redemption option. Suppose he chooses the redemption option, then what will be the entry? Well, liability component account debit to bank account. This is to a Sida Sada entry. There is no doubt in this. But then the equity component on a compound financial instrument, there is no CFI left. Array, when you redeem a CFI, where is the CFI remaining? Sir, CFI to hai nahi na, because the liability is extinguished. The instrument's time period is complete. So how can you have equity component of CFI when CFI itself is not there? Nahi rakh sakte na. So that is why the equity component of compound financial instruments, we transfer it to retained earnings entirely. This problem is not faced when the holder exercises the option to convert, because if the holder exercises the option to convert, the entire liability and equity component is getting transferred to equity capital as well as security premium. And that is why there won't be any confusion there. Okay, there won't be. We used to do a similar entry in cash settled, in ESOPs with cash settled alternatives also. Remember, I told you in that also the institute solution said that SBP reserve transferred to retained earnings, but I said that a better approach would be liability component debit, SBP reserve debit to equity capital to securities premium, because this is giving a complete hint that these instruments have opted for conversion. So therefore, you take it entirely to securities premium and equity share capital. Is it okay? Yes. So we are looking at not only, see, as when we do, see, you have come to a stage where tallying a balance sheet, debit credits, golden rules of accounting, and I mean, all these concepts are not much relevance to you at this stage because you are expected to be an expert in these. I will treat you as an expert in all these things because you have already gone through the grind of 11th, 12th, foundation, intermediate, articleship. So all of you are well molded in these concepts. But where I look at this particular level of CA finalists, it's not just getting marks. It's not just, clearing the CA final. Tomorrow, you should go in the market, in the job market, either as a preparer of financial statements or as an auditor of financial statements. And you should get a sense of satisfaction when you look at financial statements. Yes, it is absolutely clearly representing the substance of my transaction. That is the point where I believe that you have truly achieved expertise in your subject. And reporting is an area where there is always a scope for improvement, always a scope for better presentation. Okay. So if our sessions can can give that impetus to you to achieve better financial reporting, then it will be a successful sessions for me, for us, in fact. Okay. So that is the main conclusion. Okay, you can proceed. I'll just be doing one more question, Kaushiki, which is going to be very similar to what you have already done. Okay. So that takes care of the main theory part. I don't have anything else to discuss. I don't have anything else left to discuss. Okay. So now we come to a question. This is question. Okay. Well, 0.195. Just a minute. Let me search the question. 42 illustration 2. 1 second, please. Comprehensive illustrations. Second. Give me a minute. I'm searching the question. I had marked it, but I'm not able to get it. Just a second. May 22. Just give me a minute, please. Issues 1 crore bonds. Examination. Okay. Yes. But where is my question gone? Not this. None of this. Nope. Okay, fine. All right. Let us come to this question. I just need you to get a particular understanding. Okay, so that you have. We will see how to do the questions and then we shall close for today. Okay. So this is a May 22 examination question. Very simple, based entirely on what we have done. You can see that this is a 14 mark question. Okay. So this is the weightage that you can expect. Okay. And if you get a question like this, just, you can think that you did something very nice in your previous life. That is why you got such an easy question. Okay. So read the question, please. X Limited issues 1.5 crore convertible bonds on 1st April 2018. These bonds have a life of 8 years, face value 10 each, offer interest at 5.5 per annum, payable at the end of each financial year. Bonds are issued at their face value. Each bond can be converted into one ordinary share of X Limited. One ordinary share. That means, can I say fixed for fixed? Yes. None of you asked me, but anyways, that is okay. When we talk about convertibles, it is it will be convertible into a fixed number of equity shares. That is why, since it is passing the fixed for fixed test, ultimately, remember, we have to go back to the basic, right? In the basic thing, what have they said? A liability. When you talk about a liability, a non-derivative that is convertible into a variable number of equity shares, or a derivative that is convertible into other than fixed for fixed. Since this is convertible into fixed for fixed, the principal component meets the definition of equity. And that is why what is essential is it should be a fixed for fixed conversion, which it always is. If it is not given in the question, it is implicitly assumed that it is a fixed for fixed conversion. Okay. Companies of a similar risk profile have recently issued debt with similar terms without the option for conversion. So without conversion, the rate of interest is 7%. You have taken it with conversion, so therefore your rate of interest is 5.5%. Required, provide the journal entries from financial year 18-19 to financial year 21-22. Compute interest expense across all 8 years of the life of the convertible. Give the accounting entries if the holders of the bonds elect to convert the bonds to ordinary shares at the end of the 4th year. We will just pass this. Okay. We'll not do this today. Okay. Because this is early conversion or early redemption. We will see this later on. Okay. So as of now, you just ignore it. I don't think there would be any issue, but anyways, we will see what it is. Okay. All right. Fine. Let us continue. Yeah. That part we will see it later on. Okay. So now, can you start? There is another question here. By any chance, there could be, because the question which I am seeing, okay. All right. So now let us start. So issue price is how much? Issues rupees 1.5 crore convertible bonds. Rupees 1.5 crores. Coupon rate 5.5%. Effective interest rate 7%. Term is how much? 8 years. Term is 8 years. And each bond can be converted into one ordinary share. Okay, fine. So now, fair value of non-convertible bond is equal to, how do we get this? Well, this is going to be rupees 1.5 crores into 5.5%. This is the coupon into present value annuity factor 7% for 8 years. Plus you get the redemption also. Convertible into this, equity shares do not opt for conversion. Nothing is given. Conversion is at par. So plus rupees 1.5 crores into present value factor 7% 8th year. 7% 8th year. So can you do this for me? Can you get the workings for me? Yes. Yes. Come on, tell me. 7. Okay. So what is the annuity factor? Yes. What is the annuity factor? 5.389289. 5.389289. And what is the present value factor? 0.62275. So this comes to how much? I'm having a problem with my computer screen. 1 crore 50 lakhs by 100 into 5.389289. 44 lakhs 46,163 plus 1 crore 50 lakhs multiplied by 0.62275. 93, 41, 250 plus 44, 46, 163. 1 crore 37, 87, 413. How many of you got this answer? How many of you got this answer? Something close. 1 crore 47. Just check. 36 lakhs. Just check. 1 crore 37 lakhs. 1 crore 3656. This is closer. What is 0.582009? For which year, Janvi? What are you saying? Please let me know. Check if there is anything wrong in this. Yes. Let us see the workings, what they have done. Hopefully it should work. %7 for 8 years. How many years have I taken? Oh, my mistake. I have taken 7. It should be 8 years. Okay, my bad. Yes, and then equal to, yes, that's right. I took it for 7 years. I'm sorry. Yes. All right. So this will change. 5.971299, and this will be 0.582009. That's right. So this will change to how much? 1 crore 50 lakhs into 0.0 into 5.5% into 5.971299, 49,26,322 plus 1 crore 50 lakhs. You are getting back 0.582009, 87,30,135 plus 49,26,322, 136,56,457. Have you received this answer? Did you get this answer? Yes. Everyone got this answer? That's right, Janvi. I had taken 7 years. Please confirm, did you get this answer? Yes. Tushar, your discounting rate may be wrong. Janvi, your discounting rate appears to be correct, but I don't know where you went wrong. Okay, it must be a calculation mistake. Okay. All right. So that everyone got. So you can see the answer: bank account debit 1 crore 50 lakhs to convertible bonds. 400-500 का difference है, that is fine. It's about materiality end of the day. And finally, this is going to be a balancing figure. This is going to be a balancing figure. Then what you will do? You will prepare an amortization table. How will you prepare the amortization table? Opening balance will be 1 crore 36 lakh 56,075. Add interest thereon at the rate of 7%. Deduct the payment of based on the coupon rate of 5.5%. That will give you the closing balance. You will get this amount. You will get this working every time. So now I want you to tell me, without looking at the calculation, 1.36 crore after 8 years will come to how much? 1.36 crores. After preparing the loan amortization table, it will grow to how much? Okay. Quickly, it will grow to how much? I need you to get these things right, because then it would mean that you would have truly understood the amortization workings. Okay. So come on, tell me. 1.36 crores after amortizing it over a period of 8 years at the rate of 7% with a coupon payment of 5.5%. What will the liability become after 8 years? What will the liability become after 8 years? It becomes 1.5 crore. So you can check the working. Okay, so it starts with this working. So ultimately it moves on to 1.5 crores. It ultimately moves on to 1.5 crores. Okay, so I think you should be in a position to prepare this amortization table at your end. There won't be any difficulty. Then the journal entries are the usual ones. Interest expense account debit to bank. This is the coupon. And the remaining goes to convertible bonds liability. Alternatively, what you could be doing is you could pass interest to bond one entry, bonds to bank another entry. So that is also acceptable. In fact, that is what we have been doing, but you can take it as a single entry also. Okay. So 1, 2, 3, 4. This is the entry for all the years. This is the entry for all the periods. Okay. Now, if they elect for conversion, after receiving their payments, I am not sure whether, okay, 87 lakh 30,000. Okay. 5.1. Okay. All right, fine. Now, at the end of 4th year, they have decided to convert. Okay, at the end of 4th year, they have decided to convert after receiving the interest for the 4th year. So basically, you receive the interest for year 1, 2, 3, 4. Then you check what is the closing balance in your liability. This will be your balance after receiving the interest, and the convertible bonds equity capital. The convertible bonds equity element, that is this figure 1343,925, that is also going to get debited, and credit will be ordinary share capital / securities premium. Okay, so that's it. So the bond is entirely extinguished at the end of year 4 itself. Okay, so that is a simple question on equity compound financial instrument where there is an early conversion taking place. Are you able to follow? Yes, sure. Are you able to follow? Where did that question go? I'm wondering. Okay. Are you able to follow? Everyone? Difficult? Not difficult? Very difficult? Yes. Tell me. Are you able to understand? I'm just searching for one question. Here it is. Yes. Okay. All right. I want you to try this question for homework. Okay. Illustration 2. I want you to try this question for homework. Okay. I want you to do this question little bit. Tushar, tell me what is your difficulty. Okay. Tushar, tell me where you're stuck. Don't go back with any doubt as far as CFI is concerned. Okay. Where you're stuck, let me know. I will be happy to address it. Okay. I want you guys to try illustration 2 for homework. Okay. Please try illustration 2 for homework. It's a simple one, not difficult. Exactly what we have done just now. Okay, so illustration 1, do it for homework. Then we shall look at the remaining concept. Okay, so today we have done compound financial instruments, the split accounting, that is the essence of our workings. Okay, and then we will check whether I can give another question or two to you for homework. Okay, that is done. Then page 210. Second, 210. Okay. Issued 6% convertibles. Okay. K Limited. Right. So 45. Yes, Tushar, tell me what is your doubt? Okay. I want you to try question 4. It is slightly tricky, but I think you guys will be able to do it. I want you to try question 4. I definitely want you to try question number 5 also. Okay. I want you to try question number 5 also. Okay. 44. Okay, I want you to try this also for homework. Okay, so question 4, question 5. Okay, try this for homework. Then 204, illustration 6. Okay, try illustration 6 also. Illustration 6 comes with the transaction cost for which you are given this rate of 15.86% effective interest rate. Use this rate for the amortization table. You will be in a position to get the answer correctly. Okay. So try these 4-5 questions what I have given you for homework. Okay. You try it. You will be clear about the concepts. I'm not worried if you do a mistake. I'm not worried if you come to the class on Thursday and say that, sir, I got all my questions wrong. I don't have a problem. If you get all the questions wrong, I will solve each one of those questions for you physically in class on Thursday. But if you come to the class without solving, thinking that sir will anyway solve, it is going to hurt you in the long run. Okay. So please try these questions. Okay. 4-5 questions I have given. 1 or 2 concepts are a little, I won't say different, but the manner of changing the question is different. Like 50% convertible, 50% redeemable is there in one of the questions. Okay. In this question, there is a transaction cost. So you know the effect of transaction cost by now. The only thing is, try to apply your head on what do I do with the transaction cost. Is the transaction cost for issuing equity component only? Is the transaction cost for issuing the liability component only? Or is the transaction cost for issuing the instrument? If it is for issuing the instrument, can I allocate it to equity component alone? Can I allocate it to liability component alone, or should I split the transaction cost? If I split the transaction cost, in what ratio should I split? Should I split it in the ratio before allocation, or should I split it in the ratio after allocation? Okay. So try to think on these lines. Okay. Try to think on these lines. I have given you a concept to take away from here. Later on, it is an application of all what we have studied till now, plus this concept. Okay. So I want you to try these questions for that. In all probability, you may have a difficulty in illustration 6. Illustration 6, you may find it a little difficult. If you do it, excellent. If you don't do it, I will surely be taking it up on Thursday. Okay. But please try the questions what I have given you. Okay. Please try. As well as the examples that we have discussed today, try to go through them. Okay. See, you cannot say that sir has taught today and we will do it later on because the sessions are anyways there on YouTube. That is not going to work. You do the revision today, it will take probably half an hour for the entire 2.5 to 3 hour class. You do it tomorrow, it will take 1 hour. You do it day after tomorrow, it will take 2 hours plus the backlog of Thursday. So try to do it today itself. Okay. Your time will be saved and concept will be cemented in your minds. Okay. So with that, we close our session today. Okay. 1 second. Tushar, at what time to take the fair value will be PV of 6,000 into PVAF for 5 years, and when 6,000 PVAF for 5 years? Okay. See. Okay, so you are asking about this question. See, in the first example that we discussed, Tushar, it was a compulsorily convertible instrument. It was a compulsorily convertible instrument. Means what? This principal amount of 1 lakh is never going to go in the form of cash. It is compulsorily convertible. That is why we have taken 6,000 only as a market bond equivalent and the PVAF for that. We have not added the principal because this is a compulsorily convertible bond. There is no option for conversion. Tomorrow the bond holder will come to me and demand cash. I will say cash nahi milega. This is a compulsorily convertible bond. आपको equity share ही मिलेंगे. आपको cash नहीं मिलेगा. You are not going to get cash. That is why the what you can say, the face value of the bond, we are never going to have the obligation to deliver cash after a period of 5 years in this example. And that is why the present value factor of 1 lakh for the 5th year is not considered. We have considered only 6,000 each year's cash flow. Okay, so that is how we have done this. In the next part, however, in the modification that we have introduced, what we have done was we have told that it becomes a optionally convertible bond. It becomes an optionally convertible bond. That means after 5 years, the bond holder can come to me and say, "Mere ko cash de do." If he asks for cash, you have an obligation to deliver cash. And because you have an obligation to deliver cash, what is going to be your cash outflow? 6,000, 6,000, 6,000 to each year hoga hi. And at the end, also 1 lakh will go. So that is why we take 6,000 PVAF for 5 years plus 1 lakh PVF for the 5th year. Why that 1 lakh? Because now you have an obligation to deliver cash of 1 lakh. In the first case, it was only obligation for interest. Principal was compulsorily converted to equity. So there was no obligation to deliver cash. But here, in the second case, in the modified case, it is optionally convertible at the holder's option. So kal ko holder comes and asks for equity, I'm fine. But I cannot say that there is an option to convert to equity, so I will not recognize the obligation. आप ऐसे नहीं बोल सकते. The holder can demand cash if he wants, can demand equity if he wants. So you have to be prepared for the worst. You have to be prepared for the worst. So in this case, we are taking a conservative approach, which is not wrong. Again, I say, which is not wrong. Okay. It is not something which you can estimate or guess. It is something which is dependent, which is out of your control. It is based on the holder's choice, not on the issuer's choice. And that is why we recognize a liability. Okay. So if it is compulsorily convertible, don't take 1 lakh into the PVF. If it is optionally convertible at the holder's option, then you have to consider. Or it could be another case. You have, no, that won't happen. It will become a purely financial liability. Okay. So these two cases you are going to have. Did you follow, Tushar? Yes. When you take the PVF, when you take only PVF. Yes. All right. Oh God. Okay. Fine. Okay, Viraj. Yes. I hope the sessions are useful to you. It solely depends on the holder. The power is there with the issuer as well. See, we have 3 cases. One is the contract specifies, like in the first case, compulsorily convertible. So power is there only with the issuer. Second case, power is there with the holder. Okay, this is a different instrument altogether. They are not one instrument. Okay, if power is there with issuer to decide whether to convert or to redeem, then holder won't have the power. If holder has the power, issuer won't have the power. Okay, so that is how it is. There could be instruments which are mandatorily convertible. We saw that in our first case. There could be instruments which are optionally convertible at the option of the holder, in which case issuer has no power. He has to recognize a liability for the stream of cash flows plus the principal. And in case of optionally convertible at the option of the issuer, not the holder, instruments which are convertible at the option of the issuer means that Reliance Industries, has the option to decide whether I will convert or whether I will redeem. Depending on my intention, what I intend to do with this issue, I will take a call of whether I want to convert or whether I want to redeem. And accordingly, I will do the accounting. Because when it is at the option of the issuer, I have the freedom to decide because I am the one who decides everything. But if it is at the option of the holder, I am powerless. So I have to be prepared for the worst. And that is why we are recognizing a liability. We are recognizing a liability for the principal also. Is it okay? Yes. Okay. So that takes care of today's class. Thank you, everyone. You've been an awesome audience as always. I hope you guys understand something, okay, from the sessions. Even for me, it's the first time I'm taking this, okay. Please share your feedback with the institute. You may not be comfortable discussing my negativities with me only. You can discuss it with the institute so that we get a chance to understand where we are lacking. Okay. So please give us our feedback. Okay. It's a sincere request so that we are better placed to serve you better. Okay. We are placed to serve you better if you tell us where we are lacking. Okay. So with that, we close our discussion for today. We shall see each other on Thursday, Friday, Saturday. We have the next 3 continuous classes. Okay. So please do the questions which I have told you. Please do that. Okay. Thank you, everyone. Take care and good day. Good day, everyone. Okay. Thank you.